Good to meet all of you. So, I'm going to be talking about the fundamentals of blockchain. So this is the theme of tonight is yield. So specifically, I'm going to be speaking about yield and how it can be used as a fundamental indicator in digital assets. So first, maybe I quickly introduce myself and my firm. So I'm Griffin White. I come from the United States. I moved here 3 years ago to work at ETH as a statistician and programmer. So my background is in development and statistics. And then we were playing around with DeFi and realized making quite good money. And so we set out with the mission 2 years ago. We set up Narwhal to build the best bankable products available with underlying digital asset underlyings. So, just a brief overview. I'm going to be setting up some context. So the current state of things, the network state, the current state of institutional crypto products, which is in my structure here the problem, and then Narwhal's solution to this problem. So, and then some final thoughts, and then we will talk about staking. So, without further ado, so the network state. We have use cases, we have added value, but I'm sure you're all very familiar with the fact that digital assets in general are subject to a lot of like meme dynamics. So what do I mean by this? Like when Elon tweets, I don't know, it seems kind of fungible, and then NFT sales go from 800 million to 200 million in a day. So this is what I mean by meme dynamics. And it's not really the ideal situation for a mature market. So here's another example that I find particularly hilarious. He drove the price of Dogecoin up like 700% in a month by just tweeting one word, Doge. Yeah, so this is meme dynamics. And the goal is to leave the meme dynamics behind. This is operating on like a short time scale. So meme dynamics in general operate on a short time scale. And we want to provide investors with a way to generate long-term wealth. So this type of thing is really good for like people trading off of Twitter signals, momentum traders, swing traders, but not so nice for fundamental analysis and value investing. But the good news is now that blockchain has found its stride a bit and is maturing, we have real use cases, and this technology is providing real utility in the world, and that's quite cool. So rather than investing on Elon's tweets, we can invest on the actual underlying utility. That's a big thing for the maturity of blockchain. So just for example, I think probably this room needs the least amount of selling on the utility of blockchain, but anyways, I will just provide a few examples. So Uniswap, AMMs, I don't know if you saw, this paper was recently published by the Uniswap guys talking about increased efficiency, accessibility, and transparency of forex markets by using Uniswap AMMs. So we have supply chain management. The DHL, the shipping giant, is implementing a blockchain-based solution for shipping, supply chain management. And then we have cross-border settlement. So XRP, for instance, has been implemented as a cross-border settlement solution for like over 100 banks in Japan, America, Mexico, and then of course public registries, because that's what blockchain was built for. So Norway is launching this BROC, this company shareholder registry on Arbitrum. That's quite cool, and California is already registering car titles on Tezos. So insurance as well. So there's real underlying use cases. And then, of course, I just am obliged to put a little more Web3 Kool-Aid in here and talk about the reason why that's better over the current situation. Because it's fully transparent, it's open for everyone, users have full control, it's free of intermediaries, and we're mitigating counterparty risk. So these are some real some benefits we get by putting applications on the blockchain. But in general, there's one really great use case that's already, I would not say fully developed, but already in use and being used every day, and that's decentralized finance, so yield generating protocols. So we have permissionless market access for real yields on US dollars. And in Switzerland, or also America, where I'm from, it's maybe a little less important, but for people all over the world, this is a huge deal. So if you can, rather than, if you live in a place where For instance, like religious texts are governing the monetary policy in your country, the Turkish lira is the example I'm using here, or inflation is crazy, then it's a real benefit to be able to hold US dollars and generate yield on your US dollars with DeFi. So that's a real use case. And we have, because the theme of tonight is yields, I will just briefly mention that this yield is generated by providing liquidity on decentralized exchanges, by providing loans to borrowers. Let's not forget staking, of course, but I won't spoil the next talk. So yes, that's a big deal, and there's many other ways to earn some money in DeFi, but these are the main ones. So my favorite thing about yields, actually, as a statistician, is that they provide real market insight into the underlying utility and demand for these digital assets and these protocols. So what do I mean by that? So yield is a market insight. So yield has been used in bonds to estimate fair exchange rates between foreign currencies for a long time. So this is, for instance, the euro versus the dollar, here in red on the left, and the German versus the US 10-year government bond yield. And they pretty much live in a tight band together. So this is also true with the British pound and US dollar, and this is true with the Australian dollar and the Canadian dollar. So this is a pattern we see all across foreign exchange markets, is that fair exchange rates are kind of contingent upon yield differentials. So yields are a really cool way to try to understand the underlying utility of a protocol. So I will give a perhaps slightly painful example of Luna Classic versus Ethereum. We have in blue, and the yield differential between US dollars on the Luna, in the Luna system, and for Ethereum, I'm using the classic, like, risk-free, the Aave rate, which floats between 2% and 3%, I think, on US dollar coins on any given day. And this is the yield differential in red and the actual price in blue. So there's two important lessons to learn from this example. And the first one is, of course, the thing I've been highlighting, which is that DeFi yields can be used to understand fair exchange rates. So that's a really big deal. And the second really important point of this is that aggregate market is not the smartest way to invest. So that's if you're not familiar with what happened here, it's a really incredible story of a protocol printing money at 20% a year for people, and it turns out the yield was not real. Or rather became not real at some point. But anyways, check out Anchor if you're not familiar. Yeah, I won't rub it in anymore to anyone who was wrapped up in that. But anyways, that's actually the central problem with the bankable products that exist with digital asset underlyings currently, is that they are essentially set up based on aggregate markets. So, for instance, market cap weighted rebalancing. So you cannot find a digital asset index on the market that is not market cap weighted rebalanced. So this in general is a huge issue. So what do I mean by market cap weighted? If you haven't heard of this before, so let's say we have the market caps of all the high cap digital assets here in the top, and then you use these market caps to generate a portfolio, and perhaps you might remove some of these others because who knows what others contains, and you end up with a portfolio like this. Now, I'm not sure about you, but there's at least 2 assets on this list that I will never invest in. So that's an issue, right? Because people are selling to pension funds products that are market cap weighted rebalanced, when I'm not sure if you're aware, but since this stuff with Solana and Phantom, Dogecoin is now a top 5 asset now by market cap, or top 6. But that's incredible. So these market cap weighted indices in general are holding assets just because the aggregate market says hold these assets. And we already saw why that's not always the best choice. So why is that a problem? So market cap weighted rebalancing is an inherently reactive strategy, and again driven by aggregate market decisions. And by definition, it can never outperform the market because it is just investing in the current market. So what is the market holding? That's what I will also hold. And you cannot outperform the market by market cap weighted rebalancing. So this, of course, is, oh yeah, you can't stop Elon from tweeting. Look at that. He's tweeting a bunch of true things. Hi, welcome. And yeah, Warren Buffett even agrees with him there. So yeah. Oh, stop it, Elon. Okay, come on. Yeah, but it's true what he says, yeah. So what's the solution to this problem? In my opinion, this is by indexing market fundamentals. And yield is one of the most important market fundamentals for understanding the fair exchange rate between digital assets. So digital assets, like I mentioned before, they're entering a new paradigm driven by yield and utility. So just for some context, fundamentals-based indices have outperformed market cap-weighted rebalance indices for decades in the equities market, and we now have the tools to build really good models and outperform market cap-weighted rebalancing based on blockchain data. So in general, if you have no idea about the system you're investing in, market cap-weighted rebalancing can make sense because, okay, what is the rest of the market doing? I will just do that, and okay, seems like a reasonable strategy. But we're not in the situation where we don't know what's going on. We have access to a list of every transaction that's ever occurred since Genesis on every blockchain. So we don't need to subject ourselves to the aggregate market decisions to make good investment decisions. Oh yeah, and just to highlight this point, just kind of for fun, I computed the correlation between Elon Musk's tweets about Dogecoin, which I didn't know this, but there's over 180 of them. He either overtly or implicitly tweeted about Dogecoin. And the cool thing we can see is from his peak at 0.5 correlation back in the beginning of 2021, his influence is now dying off, and this is the kind of pattern I'm talking about moving from the meme market to the market based on underlying utility. So, just a fun example. So how do you do fundamentals-based indexing? So we have like just basic inference. So we have three variables, A, B, and C, and we want to predict the underlying value of a digital asset. So for instance, in equity, a really simple version of this could look like this, where you have some metrics about the company you want to estimate the value of, and you use these values to predict the fair market rate for an equity. And in forex, we have similar situation. We can use the price in country A of a good and the price in country C, and then the delta GDP over time, and essentially estimate a GDP-adjusted purchasing power parity. And this is used all the time in forex to try to understand the fair exchange rate between two foreign currencies. So just to kind of accentuate the case for fundamentals analysis, is a really famous figure I just want to put in here. This is Berkshire Hathaway, Buffett's fund versus the S&P 500. S&P 500 is famously market cap weighted rebalanced, and Buffett is a famous value investor. And the primary toolkit in value investing is a set of fundamentals. Fundamentals analysis is the primary tool used in value investing. And yeah, this is quite incredible performance over the last 50 years. So just to highlight the case that value and fundamentals-based indexing can really pay off. So how does this work in crypto, though? Because we have these things that we assume in general will imply a fair exchange rate, like long-term utility, scalability, long-term network stability, safety, these really nebulous ideas that are like really hard to quantify, right? Like you can try to quantify safety, but it's not an easy thing to do. Well, we don't try to estimate these quantities. We have a whole bunch of other data that are related to these quantities that we can estimate. And because the blockchain is documenting every transaction, we can construct essentially arbitrarily many features that we would like to use to estimate the fair exchange rate. Now, this looks like a complicated set of estimations, and indeed it is, but this is the exact problem that almost all modern machine learning algorithms were developed to solve. And so that's what we do at Narwhal, is building machine learning algorithms to try to estimate the fair exchange rate of digital assets based on these features that are important for understanding, and one of them being yield as the theme of the night. So just to justify the use of AI in investing, This is the AI equity thing that IBM, on the IBM supercomputer, performing over. This is in equities, of course, not in digital assets, but this is just essentially to highlight the point that you can use fundamental features to estimate the fair exchange rate of assets. And this is also true in digital assets. So that's quite cool. Now, does this actually work in practice on blockchain assets, on digital assets? So this is our long-only passive strategy, rebalanced very infrequently, so in the same category as these others. The HODL index from 21 shares, well, I probably shouldn't be throwing out names, but anyways, I already put them in the slide, so there they are. And Bitcoin, and then Narwhal's passive long-only strategy, indexing strategy, that we're using to build bankable products with, performing the only positive one of these in the last 6 months, or the last 6 months when this slide was made, which was the end of last December. So it's a promising thing. These yields are super important for helping to understand the demand for these digital assets. And I would just like to close with a few final thoughts. So just to recap, I kind of blazed through a lot of material here. So the market is switching gears. Meme dynamics are becoming less important, and underlying utility is the importance of underlying utility is being really highlighted in the market right now. So that's a big deal. Utility and use cases already exist. So there's millions of people using the utility that already exists on the blockchain, and this utility can be used to estimate fair exchange rates. So that's a really cool thing for investing. We can do better than market cap weighted rebalancing. And in my opinion, fundamentals-based indexing should be implemented instead. Now, the final thing I want to close on is just this figure from the most recent Nobel Prize in Economics from 2022. This is from Ben Bernanke's paper. And these are all the banks that have failed that they could find documentation of over the last 150 years. And this is really cool to me because, the Great Depression did not stop banks from existing, right? So this stuff that's going on in the market right now, it's been kind of a rough year for all of us probably. And basically, I just want to say, don't worry and be happy, because the underlying use case exists, and therefore it will persist, and the market will recover. And yeah, that's what I want to say. Don't worry, be happy, and thank you all very much for your attention. That's all I have to say. Thanks.